Today, property signs for the 25th of June 2021. Hello again, it's Martin North from Digital Finance Analytics, working on this post covering finance and property news with a distinctively Australian flavour. In today's show, we look at first-time buyer momentum, which state is growing the fastest from a property perspective, and also an update on luxury apartment sales. Plus, we ask, is the future too far away to predict, and what is China doing to rein in commodity prices? First, single first home buyers are launching themselves into the housing market in growing numbers, despite a record-breaking surge in home prices across the country, according to the latest data from ME Bank. The proportion of solo first home buyers has grown to more than a third, actually 38%, of all home loan applications received by the bank, up by 3 percentage points in 2020 from previous years. Singles are a growing force in the property market, with home loan applications from solo buyers increasing during the pandemic, said Claudia Marizella, ME's head of home loans and personal banking. Despite escalating house prices, the dream of home ownership is still a priority for many Australians, whether they're applying for a loan by themselves or with someone else. Single women made up nearly half, actually 49%, of all solo home loan applications, and that's down by 1% from the previous year. It's a poll of 1,000 investors, owner-occupiers and first home buyers, and they also found that buyers are entering the housing market earlier. Single men are buying in at an average age of 32 years, compared with 34 for women. And in 2018, the average age for the first home loan application for both men and women was 35. First home buyers also took out larger mortgages during the pandemic, reflecting higher housing prices. The average loan size for single mortgage applicants has risen by 1% to $405,755. While there can be challenges with solo applications, such as saving for a deposit and borrowing capacity, it's certainly not impossible, he said. One strategy to consider is co-buying, purchasing a property with a family member or friend, as it enables both parties to save for a deposit in a shorter time frame and increases your overall borrowing capacity. With home prices rising rapidly, a large majority of first home buyers are now willing to compromise on the type and location of the property in order to buy in the market. More than two-thirds, actually 67%, said they would consider buying a smaller than preferred property, selecting a less than preferred area, or choosing a property that needs renovations or repairs. More than 1 in 4 said they would consider buying with less than a 20% deposit and pay the costly lender's mortgage insurance in order to buy now. Getting into the current market can be challenging, but can be easier once you make compromises, he said. Sometimes it's just readjusting your mindset on what your ideal first home looks like. You could be otherwise cancelling out of some good buying opportunities. The most important thing to remember is that once you're on the property ladder, you can benefit from the rising value and equity in your home that could help you upgrade down the track. And the Domain report has found that the path to home ownership has become harder for first home buyers, who now need an additional 4 months on average to save a deposit on an entry-level house. Sydney was the toughest market to crack, requiring aspiring homeowners to save for 7 years and 1 month, as wages and interest on savings lag skyrocketing prices. But this timeline shortens by 4 months in Sydney and 2 months in Melbourne if first home buyers opt for a unit. Now, it's worth just pausing here and thinking about the basic assumptions. Firstly, that prices will continue to rise. Well, maybe. Unit prices, I don't think, will potentially rise, and so you need to be quite cautious. The other point is this: when you're extending yourself, and the average first home buyer loan size has actually gone up by 15% according to the ABS data, you are actually more exposed if rates go up. And so whilst it may appear a good time to buy, I think that people should take caution and be careful not to overcommit. And therefore the recommendation about tempering your expectations a little bit, perhaps buying a smaller place or somewhere that's not quite so convenient, may be worth considering. Queensland may be copping a beating in the state of origin, but in the property market, there's only one winner. The latest PEXA Property and Mortgage Insights report has seen the Sunshine State named as the fastest growing property market in Australia. PEXA are Australia's provider of digital property settlements and hold an 80% market share in conveyancing, and that gives them unique insights into the transactions across the country. The big headline in Queensland, said PEXA's Senior Research Manager Mike Gill, looking at the last 12 months, we've seen that Queensland has recorded the highest growth of the mainland eastern states. Queensland was up 37% year on year and recorded over 200,000 property settlements in the last 12 months. So huge growth is seen in that market. Traditionally, Queensland hasn't benefited from the growth that we've seen in the other eastern states. For the last 5 years, prices have plateaued there in contrast to what we've seen in Melbourne and Sydney in particular. It's good to see the growth we're currently seeing in the Queensland market. The growth has come from the metro markets. The greater Brisbane area was up 53% in that period, and that is where the Queensland growth was driven from. If Queensland, though, was the big winner, Victoria was perhaps the loser, although in Australia's booming property market everything is relative. We can also compare against some of the other states, said Gill. Victoria was a slightly different story. As a state, it did grow 11% in the last financial year compared to the previous one, and in most years that will be a really respectable growth number. But when you compare it to Queensland and New South Wales, Victoria lags. When you drill down to the next level to see what has actually happened in the Victorian market, it's a tale of metro versus regional. In the greater Melbourne area, property settlements were actually down 2% with the impact of that second lockdown in the late part of 2020. The metro market was really impacted by the difficulty for buyers and sellers to transact. In the same period, though, we saw the regional market grow 28%, making that the driving force in Victoria. That points to lower property prices and the trend for city buyers to favour regional areas given the more flexible working environment and the lifestyle benefits. And any doubts about the long-term attraction of the CBD has been obliterated by the remarkable splurge on luxury apartments in downtown Sydney, where some properties are selling for more than $100,000 per square metre. Agents say price is no barrier. In fact, the biggest, most expensive apartments are attracting the highest level of demand, typically from cashed-up downsizers shifting from houses in prestigious suburbs. This trend was most dramatically demonstrated over the last weekend with the sale of $400 million in apartments at the Cirrus development in the Rocks. Sales included 6 penthouses for more than $20 million, including one that went for $35 million. But that is not a blip, says Justin Brown, chairman of CBRE Residential Projects, which is selling Cirrus, with hefty price increases in premium homes now flowing through to top-end apartments. Mr. Brown said the average price at Cirrus was between $60,000 and $70,000 per square metre, with more than $100,000 per square metre paid for the penthouses. Prices are also bullish at other new high-end CBD developments such as Opera Residences, Quay Quarter, King and Phillip Residences, One Sydney Harbour, Crown Residences and the Harrington Collection. Sydney CBD luxury apartment specialist Adrian Wilson from AIR said he thought COVID-19 was positive for the top-end urban market, which had gone from strength to strength. It allowed people who may not have thought of living in town or downsizing to the city the opportunity to explore that in combination with all the prestige developments that were coming onto the market, Mr. Wilson said. Conversely, interest in investment-grade stock or some of the older buildings has declined. But Mr. Wilson said high-quality, well-located apartments are selling well, citing a 2-bedroom property at Walsh Bay with harbour bridge views that sold at auction last Saturday for $3.15 million. It last traded in 2017 at $2.12 million. That's the kind of stock which is appealing for people that want to be in a city precinct with residential amenity, so Hyde Park, Circular Quay, Walsh Bay, Barangaroo. And he said buyers are often downsizers, expats and portfolio investors that know and understand the city markets and maybe hold several properties across the CBD. It's pretty common. And Paul Marshall from Galileo Group, which developed King and Philip residences in the legal precinct near Hyde Park, said inquiry levels had lifted in recent weeks. Mr. Marshall said most interest for the building, which was recently completed and still has a few 2-bedroom apartments left at about $4 million, has come from owner-occupiers, but investors are increasingly active. It feels to me that a little bit of money might be rotating out of other asset classes. I suspect people might be getting a bit more concerned about the levels our share market is at, and money is so cheap, he said. John Green, development manager at JDH Capital, the company behind Cirrus, said the demand has been all local. A typical mix of Sydney backgrounds, older, more established purchasers. Everyone lives here, he said. The strongest demand on Saturday was for the larger and bigger apartments. You don't expect $20 million, $80 million to be walking through the door every few minutes. And JDH is also preparing to convert the former Vibe Hotel at Rushcutters Bay in Sydney's eastern suburb, which it bought for $120 million, into 123 mostly 2-bedroom apartments. Mr. Green said JDH will work with the existing development approval and the project will go to market in October. Now again, it's worth just pausing here and making the point that this of course is a small segment of the overall market, and yet of course it's the one that has really been very buoyant. That is impacting the overall momentum in terms of price indices. So we should be cautious about reading from that high-end story across to the broader market. Apartments, particularly down market, are still sliding in value, and people need to be cautious. Now, Peter Martin wrote that Barnaby Joyce has an answer to those who say Australia should commit to net zero carbon emissions by 2050. He says 2050 is too far away to be sure of anything. As he put it in February, while a backbencher, many of the politicians and commentators talking about a 2050 aspiration will be dead by then. The man he replaced as Deputy Prime Minister, Michael McCormack, said much the same thing at about the same time. He was not worried about what might be happening in 30 years' time. And while edging Australia ever closer to endorsing a target for 2050, Prime Minister Scott Morrison used the same line of reasoning. Australia's goal was to reach net zero emissions as soon as possible, and preferably by 2050. When we get there, whether in Australia or anywhere else, that will depend on the advances made in science and technology needed to commercially transform not just advanced economies and countries, but the developing world as well. For all these leaders, 2050 was simply too far into the future to have a sensible view about. But shortly after 10 a.m, Treasurer Josh Frydenberg will release a set of official projections that will go way out into the future to 2061 rather than 2050. It'll be the 5th set of official projections going out 40 years, the 5th so-called Intergenerational report. The first, produced by Prime Minister John Howard and Peter Costello in 2002, set out projections to 2042. The Howard government mandated the 5-yearly Intergenerational report as part of its charter of budget honesty. The idea was that it wasn't good enough to examine the impact of government policies just a handful of years into the future, as happened each budget night. If problems were set to build up over time, say over 40 years, budgets wouldn't give you a handle on them until it was too late. The Charter of Budget Honest Act made clear that the intergenerational reports were to deal with more than demographic change. The first identified increasing spending on new healthcare technologies unrelated to demographic changes as the greatest threat to government finances. And that first John Howard and Peter Costello report includes a sharp warning about climate change, noting that early action to prevent environmental damage, rather than later action to remedy it, is likely to reduce long-term costs. In 2010, the third Intergenerational report had an entire chapter on climate change. The report was entitled Australia to 2050. The fourth Abbott Government Intergenerational report in 2015 was prescient in its warning about the Great Barrier Reef, describing protection of it as a significant challenge over coming decades. Frydenberg's 180-page report will also include a chapter on climate change, one that looks beyond 2050. It will doubtless include the sort of disclaimers all intergenerational reports have had, that projections on the basis of unchanged settings aren't forecasts. Part of their purpose is to warn what will happen if settings aren't changed. The first warned that steadily rising spending on new medical technologies, along with the rapidly ageing population, would boost the need for tax by 5% of GDP. And as governments took measures to wind back the growth in spending, including lifting the pension age, those needs shrank in future intergenerational reports to around 3% of GDP. To date, each report has found we will have no difficulty finding the money. The first pointed to living standards 90% higher in 40 years' time. The fourth, using the same metric of real GDP per person, but assuming lower productivity growth, pointed to living standards 80% higher. With so much uncertain, the assumptions in Frydenberg's report will tell us a lot about where the Treasury thinks we are going and what needs to change. A big concern in the first report was that as the population of older Australians grew, the number of people of traditional working age available to serve each one would shrink, roughly halving. That concern was overstated somewhat because at the same time the number of young people who needed serving would shrink. 20 years on, it is clear that our population isn't ageing nearly as quickly as had been expected, in part because we've been importing many more relatively young migrants than expected. And in the year before COVID, net overseas migration reached 241,300 per year, while the first intergenerational report had expected only 90,000 per year. On the other hand, our productivity growth, the amount produced per hour of work, has been abysmal. Before COVID, it fell to 0.4% per year. The first intergenerational report assumed 1.75% per year, and the first assumptions about wage growth seem positively quaint. The first intergenerational report expected 4.25% per year. Before COVID, we got 2.1%, and there's no doubt that the assumptions and projections in Monday's intergenerational report will also seem quaint several decades down the track. But it's important to make them. The future arrives more quickly than we might think. And China has stepped up its campaign to rein in commodity prices and reduce speculation in a bid to ease the threat to its pandemic rebound from soaring raw material costs. State-owned enterprises were ordered to control risks and limit their exposure to overseas commodities markets by the State-Owned Asset Supervision and Administration Commission. The companies have been asked to report their future position for SASAC to review. In a second development, the National Food and Strategic Reserves Administration will soon release state stockpiles of metals, including copper, aluminium and zinc, according to a recent statement. The metals will be sold in batches to fabricators and manufacturers, and most metal prices in Shanghai fell, as did the Singapore Exchange iron ore contract. Shares of metal companies in China and Hong Kong declined, while Australia's metals and mining sub-index posted its biggest loss in almost a month when that statement came out. Mining and steel stocks, including Rio Tinto and BHP, fell before pairing losses later, and of course have since recovered even more. Base metal prices were mixed on the London Metals Exchange, with copper slipping. We haven't seen the country release state reserves for years, said Jai Sheng, a commodity trader with Shanghai Duang Yuan Investment Management Co. This will boost short-term supply, sending a bearish signal to the market. The scrutiny on overseas commodities positions, meanwhile, is aimed at curbing excessive speculation as prices are overheated and could bring risks to the SOEs, said Jay. The run-up in commodity prices has fanned concerns in China that factories will eventually need to pass on higher costs to consumers, hurting the economy. And the role of speculators has drawn particular scrutiny from authorities. While China has accelerated its efforts to curb inflationary pressures, the moves have had mixed results. The Chinese premier stepped up rhetoric on May the 12th, urging the country to deal with soaring prices, and iron ore slumped in the latter part of May following his comment, although it's since rebounded. And base metal prices remained much higher than last year despite a recent retreat. Goldman Sachs said last month that the country's efforts are likely to be in vain, as China is no longer the buyer dictating price, with the price dip a clear buying opportunity. China doesn't publish information about the volume it holds in its state reserves, but the government quietly sets aside commodities as a way of insulating itself from future price spikes. The material can be released in emergencies, such as previous instances of selling pork, to cool inflation concerns due to a shortage of the staple meat. This would be the first publicly announced release of copper from China's state stockpiles since 2005, when Beijing sought to dampen local prices after wrong-way bets by a government trader. Reserves of aluminium and zinc were also sold in 2010. The lack of detail on volumes set to be released this time means it's uncertain how effective the move will be on taming prices. It's also unclear what could have triggered their latest order on overseas positions. The regulator hasn't ruled out further measures, including those that target specific companies under its control. The government has already asked domestic firms, including steel mills, commodity merchants and brokerages, to reduce bullish bets on local futures markets for highly volatile raw materials like iron ore and coal. And the expansion of oversight suggests that Beijing is now seeking to exert a measure of control over the international benchmarks that influence commodity prices in China, as well as deterring speculation more generally among state-owned companies. I don't think we've seen the end of this, and to my mind this is just another illustration of how unfree many of the markets internationally are. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.